If even Warren Buffett and Kiyosaki are taking action, it is because something significant has already begun. The crash of 2025 is no longer a prediction, it is reality. But those who understand the game see this as the best opportunity to multiply their wealth. In this video, you will discover how millionaires are born amid chaos. Just before we begin, remember to like the video and subscribe to the channel to help me improve the quality of the videos. What is happening now in global markets is no longer just a warning sign, it is the very impact itself. The crash of 2025 is already underway, and it did not start with a headline. It began with something much deeper: the silent collapse of trust in the structures that underpin the economy. The symptoms are clear. Sovereign debts are at unsustainable levels. Central banks are caught between high interest rates and persistent inflation, and there is simultaneous deceleration in major developed economies. We are faced with a rare combination: still high inflation with stagnant growth, the so-called stagflation scenario. But did this really catch us by surprise? Or were there obvious signs that most chose to ignore? You will find out shortly. Those who follow cycles know this is not the case. The global market has a historical pattern of deep corrections every 7 to 10 years. The bubble of 2000, the subprime crisis in 2008, and the pandemic in 2020 are the most recent milestones. Between one peak and the next, there have always been signs. What we are witnessing now is yet another stage of the cycle. However, there is one detail that few mention. These declines are merely adjustments. They clear away excesses, correct distortions, and reopen space for real value to emerge. It is what Joseph Schumpeter referred to as creative destruction, the collapse as a precondition for a new cycle of growth. And this process is already in motion. The question is, who is really paying attention? Even with decades of evidence, most still behave as if this were the first collapse in history. Why is it that, despite such predictable fundamentals, so many are surprised? Here lies an emotional secret that differentiates millionaires from ordinary investors. While many try to exit the market to protect themselves, professional investors anticipate this happening and act with composure. Amid the panic, they ask themselves, are we in the value zone yet? And when the answer is yes, they take action. Buffett, for instance, sold a significant portion of his portfolio in recent quarters, but he did not exit out of fear. He exited it strategically. He is holding liquidity ready to repurchase assets he already knows at lower prices. The same goes for Ray Dalio, who has been pointing to the increasing risk of global debt for years and preparing his portfolio for this scenario. This is where the difference between professionals and amateurs becomes most evident. The average investor acts reflexively. They see declines in the headlines, feel afraid, and sell at the worst moment. The professional, on the other hand, follows a different path. When fear reaches its peak, they see value where the majority see risk. And here is something that almost nobody notices. This emotional pattern is as old as the markets themselves. Every crash goes through 3 emotional stages. First comes denial. It is just a correction. Next is panic. I need to get my money out now. Finally, acceptance. I have lost. Now it is a waiting game for years until it returns. Knowing where we are in this process is vital. And at this moment, the signs indicate we are entering the panic stage. It is precisely here that the great investors act. And you know what makes this even more interesting? They do not need perfect predictions. They only need asymmetry. When the relationship between risk and return begins to invert, they step in, even if it seems irrational. After all, as Nathan Rothschild, one of the greatest bankers in history, once said, the time to buy is when there is blood in the streets. The question is, can you see beyond the headlines? Now, you're going to discover exactly how to view the market like a professional investor. Imagine an asset with steady profits, a strong market position, and positive cash flow. Now imagine that it declines by 50% in price in just a few months. Has it lost value or merely price? This question holds the essence of opportunity. Market price is what is paid. Intrinsic value is what is received. It is precisely during times of crisis that this difference becomes glaringly apparent. The market, driven by short-term emotions, can lump quality assets together with fragile companies, yet those who know how to evaluate fundamentals can distinguish noise from reality. Consider the history. Stocks of companies with healthy cash reserves, properties in central locations with low vacancy rates, and tangible commodities such as silver tend to recover value over time. Furthermore, they often emerge stronger after cycles of cleansing. Thus, the strategy of the great investors is not to chase forecasts. It is to wait for moments when the price drops, but the value remains. Ben Graham, mentor to Warren Buffett, referred to this as margin of safety. It means buying assets that are worth more than they cost, with a buffer that protects the investor even in adverse scenarios. But how can one identify this practical opportunity? I will show you 3 precise criteria that you can apply today. 3 criteria are essential. First, consistent profit over the last 5 years, even in turbulent years. Second, a balanced level of debt, especially in relation to cash flow. Third, to operate in sectors that maintain demand even during crises, such as energy or healthcare. Here enters an extremely effective strategy: systematic, continuous investing. By applying the same amount monthly during periods of decline, the investor smooths out the average entry price. The point is not to predict when the crisis ends. It is to recognize when the market offers quality assets at poor prices and to maintain the discipline to continue buying while others are selling. But is that all it takes? Are there secret strategies that large investors use but few reveal? Stay with me, because I will detail this right now. There is a pattern that repeats among great investors. They do not act on impulse. They follow a plan, and this plan begins well before the market gives the green light. While panic takes hold of the news cycle, they already have their structure in place. This structure revolves around 3 simple pillars: liquidity, clarity, and execution. First, liquidity. Having available capital is the fuel for opportunity. With cash, any opportunity becomes an entry window. Second, a list of target assets based on fundamentals and not on fads. These are companies, funds, or assets that have been analyzed, awaiting only the right price. Third, a clear phased entry plan. In addition to regular investments, they allocate their cash as follows: 30% of the position at the first entry point, plus 30% if the asset falls further, and the final 40% when the market signals stabilization. These strategies protect you against the anxiety of waiting too long and the mistake of investing everything at once. And that is the point. The disciplined investor operates with a method, not with haste. Now, think about this. How many of the mistakes you have seen in the market happen due to short-term decisions? That is why the 5-year horizon is so valuable. Not because it predicts the future, but because it silences the noise. Instead of chasing immediate returns, the rational investor thinks like an accumulator. They visualize where they want to go and operate as if they are planting, not harvesting. As Howard Marks said, the risk is not in the market falling, but in you not being ready when it rises. And to be ready, it does not require genius. It requires preparation, and preparation demands consistency. If you want a secure route through crises, follow this cycle in 3 steps. First, build liquidity with discipline, even if it seems too early. Second, observe the right assets and review the fundamentals. Third, execute without waiting for the perfect moment, because it never comes. But if the cycle of panic has already begun, it means opportunities are emerging, and those who seize them will make significant profits. In every cycle of crisis, opportunities arise. However, they do not present themselves with spotlights. They disguise themselves as risk. This is why few take advantage of them. There are 3 specific assets that can multiply your wealth in the current chaos. The third of these, in fact, few people can clearly identify. Let us begin with Bitcoin. After the last halving, the event that halves the issuance of the currency, BTC has returned to the spotlight. In 2025, it is traded at around €85,000. To many, this seems high. However, historically, this asset has multiplied aggressively in the post-halving cycles. The projection, based on the behavior of previous cycles, indicates a potential appreciation to something between €170,000 and €185,000. This represents more than a doubling in value. Yet the logic here is not merely speculative, it is structural. Bitcoin has programmed scarcity. It does not rely on central banks, nor can it be inflated. With increasing adoption by funds and even governments, it is consolidating as a new value storage class, especially in times of monetary distrust. Yet volatility remains present. Therefore, its ideal position is within a portfolio strategy, not as an isolated bet. And this is where the second asset comes in. Physical silver continues to be one of the most undervalued assets relative to its potential. In 2008, it skyrocketed by more than 300% in 3 years. In addition to industrial demand in various sectors, it holds monetary value. Unlike gold, it can be fractioned, exchanged, and used directly in contexts of scarcity. Its price today still does not reflect this combination of utility and scarcity. This opens up space for significant appreciation. Now, if you want something more tangible, look at real estate. In major urban centers, prices have already undergone corrections of 15 to 25% in recent quarters. However, the structural demand for housing in these regions remains strong, especially when combined with intelligent use of credit. Imagine a property valued at €300,000 that can be acquired with only €30,000 as a down payment, 10%, using €270,000 in financing. After the crisis, this property recovers and becomes worth €360,000, a 20% appreciation on the asset. But on the invested capital, the €30,000, the return was 100%. This logic works anywhere because it is based on proportion and return on equity. And it has already been proven. Between 2010 and 2016, during the European recovery, central residential properties increased by more than 40% in various capitals. Those who bought during the moment of pessimism reaped rewards in the normalization cycle. For decades, the model of 60% in equities and 40% in fixed income securities has been regarded as the standard for those seeking security alongside growth. However, what worked in the past has ceased to function in the present. This model was not designed to survive in an environment of high inflation combined with pressured interest rates. And this is precisely the scenario of 2025. The portion allocated to fixed income, which should serve to protect the portfolio, is now causing losses. At the same time, the equities part, often exposed to overvalued companies, is unable to compensate. And therein lies the fatal error. Following ready-made formulas may seem rational, but when the premises change, insisting upon them becomes dangerous, especially when it pertains to one's own retirement or long-term financial independence. Therefore, those seeking solidity need to think differently. This is where the concept of an anti-fragile portfolio, proposed by Nassim Taleb, comes into play. Unlike a portfolio that merely endures volatility, an anti-fragile portfolio benefits from uncertainty. It is constructed with assets that not only survive shocks, but actually grow alongside them. Want a practical example? 40% in consistently paying dividend stocks, 30% in liquidity, and 30% in protection through physical gold, silver, and Bitcoin. The question that remains is your portfolio truly prepared for the unexpected, or does it merely seem secure because it has never been tested? If this content has brought you clarity, please like the video and subscribe to the channel. Here, each piece of content connects a part of the financial puzzle that few see entirely. Now that you have seen how crises shape fortunes, the next step is to apply. This is the difference for those who accumulate wealth while the world panics. We will see you in the next video.